Talk about the markets, stock market, probably more general, maybe both. Join us now, Kristen Bitterly, global head of Citi Global Wealth at work. You were expecting 25. I think you were pretty sure it would be 25.
We were pretty sure it was going to be 25. I think they surprised us with 50.
What does that indicate to you? That they are taking a victory lap on inflation, or they're trying to get ahead of labor weakness?
I think it may be a little bit of both. I think they've been very clear in terms of how they feel about inflation, and that they see clearly the data, especially over the past couple of months, going in the right direction. I think we were in the camp of 25 just because the last inflation print that we received, there was some stickier inflation in there, particularly when it came to owners' equivalent rents. But 50 basis points, I don't think we should read too much into whether it's 25 or 50. I think it's ultimately what is the trajectory from here. And then we need to look through into the data. As long as the employment data holds up, then this is really kind of aiming for the soft landing that the Fed wants and actually the market wants as well.
Because in the past, you would only see, it wasn't, like you say, it wasn't shock and awe, and maybe it was making up for not cutting 25 at the previous one. But normally the stock markets aren't hitting new highs, and unemployment isn't at historic lows. That's not a time where you seem to have not an emergency rate cut, but a significant rate cut. Why? Why not save it for when you might need it?
Look, we're in agreement with you in terms of why not save it for when you need it. But if we look, perhaps going back into July and the data that they had in July and then the revisions to the job reports, it may just simply be that we know that policy does act with a lag. And so looking at some of not really massive deterioration in the employment backdrop, but some deceleration, just wanting to be ahead of that curve. And I think the other thing that we all have to keep in mind is that the Fed's mandate has nothing really to do with where the stock market is relative to its all-time highs. It's more about employment and price stability, and obviously the functioning of markets. So looking if inflation, if that battle has been won, now it's more about the employment backdrop and making sure that we kind of stay around this 4% unemployment rate.
I guess if you believe that inflation was supply chain related after the pandemic, but there's no doubt that a couple of additional spending bills and stimulus in the midst of supply chain problems caused inflation to get pretty bad.
Absolutely.
Now, I know oil hasn't been on anyone's radar screen for different reasons, for supply reasons, I guess. But it just seems like we aren't at 2. It seems like you could easily, we've got all this spending still in the pipeline for infrastructure, for chips, for IRA, for all this stuff. We're not through that at all. It seems like inflation could easily come back. And it might be that the Fed has, that's the main thing a lot of people think the Fed should be concerned with.
And when we look at the statement of economic projections, I think that inflation, I think you're right. They may be kind of overly aggressive in terms of where they anticipate inflation to be. Maybe it's going to hover around that 2.5%, and that's something that could be sustainable for the near future. But I do think, one of the interesting things and how this is impacting both markets and the economy is we're not talking about deflationary forces. We're just talking about disinflation. And so all of that price increase that we've seen is actually still there,
still going up,
which kind of goes into, some of the arguments around the K-shaped economy, who's actually experiencing that inflation and what does it mean going forward?
And retail sales,
still very strong.
That was a hot number.
Still very strong. And when you look overall, this is kind of like translating it back into what does it mean for your portfolios and what should you do right now? You still have $6.5 trillion in money market funds. You do have inflation coming down. Now you have rate cuts, and we're actually with record profitability when we look at U.S. companies' earnings. So all of that is actually a pretty constructive argument, even with a lot of these worries that are on the table, whether it comes to election volatility, the seasonality. The market is kind of telling you with that backdrop that there's still a lot of capital that wants to come into this market.
So the S&P continues to rise through the end of the year?
I think we'll end up higher in terms of the S&P 500. I think October, we do have to keep in mind that that is a challenging month, just given the fact that there is election uncertainty. And so in every election year, you tend to have a negative October where people are just taking their gains, taking chips off the table. But once we have certainty into the results of the election, you tend to then see a rally into the end of the year.
And then next year?
And then next year, I mean, I think we have to go back to fundamentals. So we can look at what are the election results and let's look at fundamentals. Maybe we start with fundamentals. In earnings, we anticipate that we're going to have 10 out of 11 sectors with earnings growth this year. Note that last year we had 7 out of 11 in an earnings recession. That could actually be 11 out of 11 going into 2025. I think on the election front, what a lot of people are looking at is tariffs and taxation. But we have to keep in mind that policy really drives that, not politics. And so until we have visibility, and right now the probability, it looks like within all polling data, is that it's going to be a divided government. So in that, what is the probability that anything could actually change, whether you're looking at the corporate tax rate, the personal income tax rate, et cetera?